Welcome to HouseLux Estate, your guide to successful investing. We're here to equip you with the tools and insights you need to make informed investment decisions. Today, we're taking a deep dive into an essential topic that often leaves many scratching their heads: understanding a company's financial health. This is a crucial step in your investment journey. In this video, we'll break down the process of evaluating a company's financial health into simple, easy-to-understand steps. The first step to evaluating a company's financial health is understanding its financial statements. Let's start with the income statement. This is often the first financial document you'll encounter. It provides an overview of a company's revenues and expenses over a specific period, typically a quarter or a year. The bottom line of the income statement, known as net income, reveals if a company is profitable or not. A consistently profitable company is usually a good sign for investors. Next, we have the balance sheet. This snapshot of a company's financial position showcases its assets, liabilities, and shareholders' equity at a specific point in time. Assets are what a company owns, liabilities are what a company owes, and shareholders' equity is the difference between the two. A healthy balance sheet generally has more assets than liabilities, indicating the company has resources to pay its debts. Finally, there's the cash flow statement. This document shows how a company manages its cash, detailing cash inflow from operations, investing, and financing activities. It's important because even profitable companies can run into trouble if they don't manage their cash flow properly. You want to see a positive cash flow from operations, indicating the company is generating enough cash from its core business. Each of these financial statements tells a different story about a company's financial health. The income statement shows profitability, the balance sheet displays financial position, and the cash flow statement unveils cash management. These statements are interconnected. For instance, net income from the income statement impacts the balance sheet's shareholders' equity and cash from operations on the cash flow statement. By understanding these connections, you get a clearer picture of a company's financial health and can make more informed investment decisions. Remember, financial statements are just a starting point. They offer a snapshot, not the whole picture. Other factors like market conditions, industry trends, and company strategy also play a vital role in determining a company's financial health. Understanding these statements allows for a comprehensive view of a company's financial health. So let's move on to the next step: analyzing financial ratios. Next, we move to analyzing financial ratios. This is where we dive deeper and start making sense of the numbers. Financial ratios are like a company's vital signs. They give us a quick, comprehensive look at a company's financial health and performance. Let's start with profitability ratios. These ratios measure a company's ability to generate earnings relative to sales, assets, and equity. They include the gross profit margin, net profit margin, and return on equity. The gross profit margin, for example, tells us the percentage of revenue left after subtracting the cost of goods sold. A higher gross profit margin indicates a more profitable company that has better control over its costs compared to its competitors. Next, let's move to liquidity ratios. These ratios measure a company's ability to pay off its short-term liabilities with its short-term assets. The two most common liquidity ratios are the current ratio and the quick ratio. The current ratio divides a company's current assets by its current liabilities. A current ratio of 1 or above suggests that the company can pay off its obligations over the next 12 months without earning additional income. Lastly, we'll discuss solvency ratios. These ratios measure a company's ability to meet its long-term obligations. The debt-to-equity ratio, for example, compares a company's total debt to its total shareholders' equity. A lower debt-to-equity ratio usually implies a more financially stable company. But remember, what's considered a good ratio can vary widely depending on the industry. By analyzing these ratios, we can gain insights into a company's profitability, its ability to manage short-term and long-term debts, and its overall financial stability. It's like peering into the company's financial soul. But remember, these ratios should not be looked at in isolation. They should be used alongside other financial analysis tools and compared with industry averages to get a holistic view of a company's financial health. These ratios provide a quick snapshot of a company's financial health. They're the beacon guiding investors through the complex world of financial analysis, shedding light on the company's strengths and potential areas of concern. A crucial aspect of assessing a company's financial health is evaluating its debt levels. Now, debt isn't inherently bad. It can provide the necessary capital for growth and expansion. However, excessive debt can hamper a company's ability to operate efficiently and stifle its growth potential. So, how do we determine if a company's debt level is manageable or excessive? The answer lies in comparison. By comparing a company's debt level with its industry average, we can gain valuable insights. If a company's debt level is significantly higher than its industry average, it could be a red flag. It might indicate that the company is over-leveraged, which could potentially lead to financial distress or even bankruptcy. On the other hand, if a company's debt level is significantly lower than its industry average, it might suggest that the company is under-leveraged. While this might seem like a good thing, it could also imply missed opportunities for growth, as the company isn't fully utilizing debt as a source of financing. Remember, every industry has its own norm when it comes to debt. In capital-intensive industries like utilities or real estate, a higher level of debt might be normal. Conversely, in less capital-intensive industries like software or services, a lower level of debt might be the norm. A manageable debt level is a good indicator of financial health, so always keep an eye on this crucial factor when evaluating a company's financial health for investment. Operational efficiency is another key aspect to consider. It's the concept that a company is making the most of its resources, and it's a critical determinant of its financial health. To put it simply, a company that efficiently uses its resources is likely to be more profitable than one that doesn't. So, how do we measure operational efficiency? Well, there are several key indicators that can give us a good idea. One of these is inventory turnover. This measures how many times a company's inventory is sold and replaced over a given period. A high inventory turnover rate may indicate that a company is effective at managing its inventory, selling its products quickly, and not tying up too much capital in unsold goods. Another important indicator is receivables turnover. This ratio measures how efficiently a company collects payments from its customers. A high receivables turnover ratio suggests that a company is efficient at collecting its accounts receivable and has a customer base that pays their bills on time. This can be crucial for cash flow, especially for businesses that operate on tight margins. But remember, context is crucial when interpreting these ratios. For example, a low inventory turnover might be a red flag for a retailer, but it might be standard for a manufacturer of heavy machinery with long production cycles. Similarly, a high receivables turnover might indicate efficiency, but it could also mean the company is too aggressive in its collection practices, which could alienate customers. So when you're evaluating a company's operational efficiency, don't just look at the numbers. Consider the company's industry, its business model, and its competitive environment. It's all about understanding the story behind the numbers. In conclusion, operational efficiency is a vital aspect of a company's financial health. It can impact profitability, cash flow, and ultimately, the company's ability to grow and create value for its shareholders. A company with high operational efficiency is likely to be financially healthy. To wrap up, evaluating a company's financial health is a critical step before investing. We've taken a journey together, exploring the nuts and bolts of financial analysis. We started by understanding financial statements, those crucial documents that provide a snapshot of a company's financial position. We then delved into the world of financial ratios, those essential indicators that help us interpret the raw data from financial statements. They offer us valuable insights into a company's profitability, liquidity, and solvency. Next, we examine debt levels, a vital consideration for any investor. Is the company over-leveraged, or does it maintain a healthy balance of debt and equity? Finally, we assessed operational efficiency, a key indicator of how well a company uses its resources to generate profits. Remember, a thorough financial analysis can help you make informed investment decisions. Thank you for watching HouseLux Estate. Please subscribe for more insightful videos.